Paying taxes is a part of life, but here's the thing. You really don't need to leave a tip to the CRA. And if you're in retirement, managing your taxes becomes only more important. But after walking through about 10 different retirement plans in the last few weeks here for folks who had not heard of this one tax strategy, I just kind of figured it was high time that we cover it here on this channel to give it the light of day, right? I certainly don't want to keep this tax strategy hidden under wraps either. I think the world would be a much better place, a whole lot better if even more people did this thing. Heck, even the government wants you to do this. Like seriously, it's true. So in this video, I'll unpack a curious little tax strategy that you might be able to put to work to save you some big bucks in retirement while also doing your kind of trusted government a solid. Let's dive in. Okay, so let's just cut to the chase. What I'm talking about here is donations of appreciated securities. This is the secret sauce of many of the plans that we build. And when paired with the right giving vehicle, it can absolutely transform your charitable giving and it can maximize your tax savings. And if I'm lucky, a handful of you will take this, you'll do this, and the world will no doubt be a better place because you did. So this video was inspired by a recent conversation that I had recently with a client. We'll call him Sean, John, call him whoever you want. We'll call him Sean. Sean was approaching retirement. He had about $2 million in a DIY investment account. It was a non-registered, kind of an open account. He was managing it on his own, along with some smaller RSPs and some TFSAs. He's doing a decent job of it, but he hadn't really had someone take a look through his stuff for optimizations, things that could be improved ever before, really. So when we were working together, we took a look through Sean's tax return, and we saw a significant amount of charitable giving, about $20,000 a year of charitable giving he was doing. Now, this is meaningfully more than the Canadian average. According to the recent CAGP Influence, Affluence, and Opportunity report, only about 17% of Canadian tax filers claimed a donation tax credit in 2021. Of those who did, the average total individual charitable claim was about $2,377, a number that's been steadily increasing, in part thanks to guys like Sean who are kind of pulling their weight. And all of that in spite of dwindling participation from the community more broadly. In fact, according to the same CAGP report, a mere 5,530 donors represented about 23.4% of personal giving in Canada in the year 2000. But that's not the point. Sean's doing the right thing. It turns out he's just doing it the wrong way. You see, Sean was drawing from his sizable non-registered investments to make these donations in cash. And this created a double whammy for him. Sean's situation is far from unique. Most retirees I talk to don't realize that there's actually a better way to do this. Now, the CRA doesn't actually mind if you keep giving the cash. They won't tell you to do it differently, right? Like, it just means that they're collecting more taxes from you. But with a little bit of planning, there's actually a way to give smarter, maybe save even more tax and have a bigger impact with your donations. By the way, if we haven't ever met, I'm Steve Willems. I'm a practicing certified financial planner and wealth advisor with the Willems Wealth Planning Group out here in BC. We started this channel to help you plan for your own retirement, helping you think about how to plan and arrange your investments, your income streams, and ideally pay less tax along the way. So here's how it works. Instead of selling your investments to make a cash donation, you're going to transfer the investments, the securities, directly to the charity. Now, when you do this, you're going to unlock two major benefits. Number one, you're not going to have to pay any capital gains tax. When you donate publicly traded securities, you're going to completely avoid paying capital gains taxes on the appreciation of those investments. Normally, when you sell investments, 50% of the gain is going to be taxable. But with an in-kind donation, that tax disappears entirely. Now, second benefit is you're going to get the full tax credit based on the market value of the thing that you've recently donated. The charity is going to issue you that tax receipt for what they're going to deem as the fair market value of the security on the day of the donation. It means you're going to get the same charitable tax receipt as you would with a cash donation, but you've avoided this capital gains tax. Let's break this down with a real world example here for Sean. So Sean was the client that we had introduced earlier. He had $100,000 worth of publicly traded securities in his non-registered portfolio. These are things that he'd owned for decades. They'd grown meaningfully in value over time. These investments had an adjusted cost base or a book value of $10,000, meaning there was an unrealized capital gain of $90,000. Now, importantly, Sean had a big tax bill this year, so he was itching to create some extra tax credits that he could use to make a dent against that tax bill. So he was open to the idea of supersizing his charitable giving in this year specifically. Now, here's what happens when Sean donates the securities directly to his favorite charitable organization. First, that capital gains tax is going to be avoided. So normally Sean would have to pay tax on 50% of that $90,000 gain, or $45,000. Now, assuming, let's say he's living in Manitoba, he's got a marginal tax rate of about 46%, he would owe about $20,880 in capital gains taxes as a result of selling these holdings. By donating the securities in kind, Sean is going to completely avoid this part of the tax entirely. Now, the second, Sean's going to receive a tax receipt for the full $100,000 market value of these donated investments. In his province, the combined federal and provincial charitable tax credit is going to be about 46%. This means that Sean's going to get a tax credit worth about $46,400. So let's just compare this side by side to see how this plays out. So first, in the cash donation scenario, Sean's going to be selling those securities, going to pay $20,880 in capital gains tax. He's still going to donate the full $100,000 though. So he's got net tax savings, which would be the tax credit less the tax on the gain, about $25,520, and an after-tax cost of the gift, which would be kind of the fair market value, the $100,000, less the tax savings, of $74,480. So he's out of pocket the $100,000, but that saved him some tax, but he also had to pay some tax, so the out-of-pocket is $74,480. Now, in the second scenario, the in-kind donation scenario, Sean donates the securities directly. He's going to avoid that $20,880 in capital gains taxes, and he's still going to receive the $46,400 tax credit. So Sean's got net tax savings here of $46,400, and he has an after-tax cost of the gift of about $53,600. So simply by changing how Sean makes this donation, kind of restructuring it more thoughtfully, will net Sean an extra $20,880 advantage over just giving the cash. Now, this doesn't just benefit Sean, it also benefits the charity, right? By donating securities instead of the cash, the charity is going to get the full $100,000. They'll typically choose to sell the securities immediately, but they can also hold on to them as a part of their own investment portfolio, should they choose. Either way, it's just a more efficient way to give. So that's how donating securities in kind can be a game changer for your charitable giving. But often when we unpack the strategy, we might hear some kind of objections, right? Some common ones, actually. Things like, well, number one, my charity doesn't accept, gifts of securities. Or number two, I don't want to donate such a large amount all at once. Or maybe number three, I'm just not sure what charities I would want to support, but I need the tax credit now. All very common objections. So this is going to be where donor advised funds come in, or DAFs as we might shorthand them. Now, a DAF is going to be like a charitable investment account that gives you an immediate tax benefit while letting you decide where and when you want to distribute the money. You can think of it like a charitable investment account, a giving wallet, or something along those lines. Now, a donor advised fund, or a DAF, is going to be a fund established within a larger foundation or an operating charity. It's going to be like your own private foundation buried inside a larger foundation. You get to even give it a name if you wish. Okay, the Sean Shortbread Family Foundation, or whatever the heck you want to call it. Now, to use this giving vehicle, to use a DAF, you need to make an irrevocable gift to the donor advised fund. And based on that transfer of ownership, you're going to get a tax receipt for the value of the thing that you transferred into the DAF. In this case, we've talked about giving appreciated securities, but you could also transfer cash, insurance policies, other types of financial assets. There's even technically ways to do private company shares. Often you have a choice to then invest those kind of giving wallet dollars if you'd want to hold on to them for a little bit longer, or you can just keep it in cash. Then you as the fund donor is going to make grant recommendations as to how you want to see those giving dollars ultimately allocated out to operating charities in the future. You make the recommendations, and then the DAF foundation, right, the DAF provider is going to send that money out to the charity recipient that you're describing. So how do DAFs solve some of these problems? Well, that first problem, my charity doesn't accept securities. Not every organization has the ability to handle these types of irregular gifts. Some smaller charities, they just don't have the infrastructure, maybe the manpower to accept and liquidate stocks in this way. With a DAF, you don't need to worry about this. The DAF provider is going to handle the donation of securities. They do this all the time. They're going to receive them, sell them, convert the proceeds to cash within the fund. And from there, you get to grant the money out to any qualified charity, whether they accept securities or not. Easy peasy. A second objection, I don't want to give that much all at once. Let's say you've got a big financial windfall or maybe a high income year, and you're ready to donate a significant amount to save on taxes. You kind of get the theory of that. But you don't want to overwhelm your favorite charity with a huge kind of one-time gift. Or maybe your chosen causes can't efficiently use that much money all at once. With a DAF, you can make the larger donation now. You can get the tax receipt immediately and then distribute smaller amounts to various charities over time, maybe even years. This is going to give you the flexibility of maximizing your tax savings in the year that you need it most, without overwhelming the flow of the money out to the end charities. Now, that third objection, I don't know who I want to give to, but I need that tax receipt now. This has got to be one of the biggest advantages of using a DAF. You can donate those securities today. You'll receive that full tax credit based on the market value of that donation. And then you can take your time deciding what causes you actually want to support. You can think of it, again, as a charitable savings account, a charitable checking account, a giving wallet. The donated funds are going to remain invested or perhaps just sitting in cash inside the DAF. They may even grow tax-free until you're ready to recommend grants to those specific charities. Donor-advised funds are rapidly gaining traction here in Canada and abroad. According to that CAGP report on DAFs, charitable contributions through these funds have grown really significantly over the last decade. By the end of 2021, there was about $8.5 billion of total assets that were held in donor-advised funds. And in that same year, 2021, they received new flows of $2.2 billion. It represented about 9.8% of all donations claimed for tax purposes, which was double the amount that was claimed in 2019. The flexibility that they offer, kind of combined with that immediate tax benefit, makes them a really good tool for retirees and for high income earners that are looking to optimize their giving. This whole strategy, paired together, right? The donations of those securities, the use of donor advised fund, it's all great. But if you're a business owner with appreciated securities held inside your corporation, this strategy gets like 100% better because the donation of securities in kind from a corporation creates a capital dividend account credit for the full capital gain of that donated security, not just the taxable amount. This is like a small bit of nuance, but a massive, massive, massive difference. When you do this, this allows business owners to withdraw tax-free funds from their corporation for personal use, essentially converting a charitable donation into an additional tax savings opportunity. It's really a thing of beauty. If you haven't ever seen this before and you want to know more, let's chat. I'll put a link to my calendar in the description below. I'd really love to show you how you can unlock this to be able to give away even more money. So when it comes to maximizing the benefits of strategies like donating in-kind securities or maybe even using donor-advised funds, timing and planning are everything. You can't just make ad hoc decisions kind of at the end of the year, December 31st. They got to be a part of a longer term kind of intentional approach to managing your wealth, your taxes, and the kind of impact that you want to leave. And you might be thinking, like, aren't these just loopholes? Like, surely this will be kind of shut down and closed down. I highly doubt it. There certainly might be other, tax loopholes that we're not going to be discussing here, but that's not what's going on here. These are intentional incentives created by the government to encourage charitable giving. You see, when we give to charity, we're not just supporting kind of the causes that we care about. We're actually helping fill gaps or cracks in the fabric of our communities that the government then doesn't have to use resources to efficiently address. Like, just think about it, right? Charities can often operate at a level of agility and cost effectiveness that governments just can't match, right? They're going to leverage volunteers. They might pay lower salaries than kind of traditional government staffers. They're going to respond faster to emerging community needs. Out here in Abbotsford, when our local town was hit by devastating floods a few years ago, it was our local community foundation that I was a part of that rapidly raised over $4 million within just a couple of weeks, right? Quickly redistributing resources to those affected long before any government help actually arrived. By incentivizing charitable donations through mechanisms like the capital gain tax exemption and maybe the use of donor-advised funds, the government is essentially saying, hey, we want you to be a part of the solution, which I think is pretty cool. So when you make a gift of in-kind securities or you use a DAF, you're not just gaming the system, right? You're participating in it exactly the way that it was designed. You're aligning your resources with your values. You're going to reduce your taxes. You're going to empower the organizations to make a real difference in the world. In the end, this is just all about doing good in a better way. So, hey, I hope you found that helpful. Just a bit of a deeper dive in an area that I don't think gets too much attention. Thanks as always for watching. I'll see you in the next video.